Bless Squad, what's going on with y'all, man? It's your boy, Blessed Applesauce, here to bless y'all with another video here on Blessed to Invest. And here today, we're here to talk about trading and why trading is gambling. Not really, but a lot of people believe trading is gambling, trading is risky. It's like going to a casino or a slot machine and just putting money in and just crossing your fingers and hoping you get money out. And a lot of people just don't understand what is involved in trading and how it works. So that's what I plan to do, is break down exactly how trading works. It's not risky. It's just understanding risk, how to manage risk, and putting the edge in place so you can make money consistently. So the example I have here today is the casino. So a lot of people, I'm quite sure, have been to a casino and seen this table here, this roulette table. It's known for having 18 red spaces, 18 black spaces, and 2 green spaces. So what this has is 38 different places to pick. And what you can do when you go to the casino, you can pick a number, or you can pick a color, basically. So when you pick a color, you have, let's say you pick red, you have 18 out of 38 chances of winning red. If you pick black, you have 18 out of 38. And if you pick green, your chances are even lower. You have 2 out of 38. So what happens is the odds are not in your favor. And let's go to that now. So if you pick any of these, you have a 40. So if you pick red or black, you have a 47% chance of winning, of being right. If you pick green, the odds are even less. But what the casino does, they realize this when they're looking at all these pieces here. They want to make sure the odds are in their favor. They have a 52% chance of making money while you only have a 47. That doesn't seem very fair. And that's exactly what the casino does. They want to make sure the odds are always in their favor. So whatever color you pick, they're, at the end of the day, they're going to come out and make money. So let's say on the first 2 or 3 tries, you pick red, 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 and they all become winners. Even though they're winners, the odds are still not in your favor, because if you roll this series 100 times, 1,000 times, you're not going to end up making money. You're going to end up losing money. And the casino knows that. So they want to play as many games as possible. They want to pay hundreds, tens of thousands, millions of games, because they know if they keep putting people in this roulette table and they keep letting them put bets on, they know at the end of the day the casino is going to clean up because the odds are in their favor. Same way, if I gave you a coin and the coin was weighted to be, let's say it was 60% heads and 40% tails, you're going to want to pick heads every single time. If we're doing a series where you win $1 every time you get heads, and I lose $1 every time you get tails or whatever. So that's how that works. I think, is that right? Yeah. So that's how that works. So it's just a weighted system. The casino puts the odds in their favor that they can make money. So over that big series, the probability, the odds are they're going to make a lot of money off of the edge they have in the casino. And what we can do as traders, we can have that same type of edge. We want to put the odds in our favor. We want to have the same system the casino does. So if they have one system where they have a 52% edge on us, we want to have the same system in the market, where we can have, in the market, you can have a 60% edge, a 70% edge, 80. Sometimes you can have a 90% edge, where you can put a trade on and you can understand that the odds here are 60%, the odds here are 70%. That's the type of condition you want to be in the market. And that is what professional traders look for. They look for some type of edge where they can be a casino and not a gambler in these situations, because they know if they keep on taking the trade 100 times, 1,000 times, 10,000 times, they know that spread, the odds will be in their favor, that they will consistently make money. So I have a couple examples here showing you exactly what I mean by this. So In the market, you're going to have three basic trends. These are bare bone bases. It gets a little bit more complicated than this when you're looking at markets. But overall, generally, this is what you're going to have. You're going to have an uptrend, you're going to have a downtrend, and you're going to have a sideways trend. So on the uptrend, it's pretty easy to see that it pushes up, corrects, pushes up, corrects, pushes up, and then you can guess what's going to happen here if it corrects. You can assume that the odds are in your favor that it's going to continue to push up if it were to correct again. And that's where we get our edge. We're looking at the market, identifying certain levels and understanding, okay, if it pushed down here, the odds are based on this upwards trend, it's most likely going to continue to push upward. And that's where we have our edge. The same with the downtrending stock, just in reverse. And also you can see with the sideways as well. These are my personal favorites to trade. You can see your lower side, your support level. If you haven't seen my support and resistance video, it'd be a good time to check this out to understand exactly what support and resistance are. But this would be your support level here, the lower level, and up here would be your resistance level. So you can see the odds are in your favor that it's going to push up to this level and then come down to this level, push up to this level, come down to this level, because you see the repeatable pattern that this thing has made over X amount of days, X amount of months, X amount of years, whatever. And that's what happens in these stocks, in these markets. So it's basically about putting the odds in your favor and becoming the casino. So next, what you want to do in the market, a little bit different with the casino, we can make even more money because we can, instead of the casino putting up $100 and you putting up $100 and it's even, and they just take the spread of what's in between after that series, the 100 series, the 1,000 series, we can put up, we can risk $1 to make $2 or $3. So in the market, we can put what is called a stop loss. So imagine we have this sideways trend here and we see, okay, this market is down here. And currently we believe, based on this previous trend, that the odds are in our favor. Let's say a 60% chance that this market is going to push up to this upward level here. And we say it's about a 60% chance. So what we want to do, if we're wrong, we want to put a stop loss in place right below here to only risk a small amount of what we're willing to make. And that's what puts our risk, what is called a risk to reward. It puts our risk to reward greater. So we're risking $1 to make $2 or $3. So as you can see here, this reward is a lot bigger than putting a stop loss here and just risking this. All right, guys. So with this video, I kind of wanted to give an example of what I was referring to when I was talking about the risk to reward ratio. I wanted to give you an actual chart so I could completely understand. So this is a chart of a company called AD&T. I don't know exactly what they do, but I just like the chart formation for explaining exactly what I'm talking about, referring to risk to reward. So notice how the stock continues to bounce at this level. You can identify a level where people are becoming interested and it tends to push up. The same way here on the reverse end, you can notice where people have become less interested and it begins to push down. So this is what I'm referring to when I'm talking about a risk to reward ratio. So when you're identifying your risk to reward, you want to look at your potential profit. So let's say we're right here. We're looking at a stock and it's right here on this level. Let me draw a circle right here. So let's say we're looking at this company right here, and it's at this level of $19, and we're like, okay, the potential profit on this thing is, whoops, wrong key. The potential profit on this thing is around $26. So potential profit is around this level because we can identify that this level, for some reason, buyers become less interested and it tends to sell off. And we know our potential risk is down here because if it were to get down here, we know that the trade is invalid and we were wrong about it pushing up in this direction. So that's exactly what I'm talking about from a risk to reward standpoint. So let's say we were to put our stop loss right down here, and let me change the color so we can identify the stop loss. We're going to make this purple. So stop loss is going to be purple line right here, and our target, our reward, is going to be this line right here, and we'll make that blue. We'll make that blue. Nah, let's make it green. We'll make it green. So that is our reward, and that is our risk. So notice how the reward here is a positive $6.14, and the risk is only $1.30. So the risk to reward ratio is a lot more than 2 to 1. So let me do the math on that real quick. So $6.40. So that gives you like a 4 to 1 risk to reward ratio on this play, basically. So you're only risking $1 to make 6, a little more than 6. So that is what I'm referring to when I'm talking about risk to reward ratio. Just identifying the levels where buyers become less interested, and we know it's a good place to take profits, and also a level where we know you're wrong about the trade, and that is your total risk that you're willing to take. But that is exactly what I'm talking about when I'm referring to risk to reward ratio. Just identifying your risk, how much you're willing to lose, how much it is, versus how much you have potentially to gain. And that's how you identify these levels. Simple as that. That's basically how this works. We are just trading a system over and over again, the same way a casino does at a roulette table, where they know they have edge. They understand the market, how it's structured, and they know if they keep on trading this particular chart pattern, this particular setup over and over and over again, because they know that the odds are 60%, 70%, 80% in their favor that this is going to work. They know they can keep on doing it over and over again. And what they do is put a stop loss there that limits their risk to a certain amount, and then analyze where the reward would be and see, okay, if I'm winning 60% of the time, I'm losing $1. And every time I lose $1. And every time I win, I'm making $2. That seems like a pretty good bet to me. And that's how professional traders make their money. They're just managing their risk, knowing their odds, knowing their edge, and putting the risk to reward in their favor. If you have any questions about that, shoot them down in the comment section down below. I'll try to answer them as quickly as possible. Hopefully I've broken this down for you as easily in its simplest terms as I could. I am going to have videos about the stop loss, how the different type of stop losses you can put. I might leave an annotation up there explaining exactly how to place a stop loss. And I also created a video on how to identify support and resistance, so you can find where these good levels to buy at, where you have edge in the market. Make sure you leave a like on this video, spam the like button. I'm putting a lot of work into these videos. And that's going to wrap it up. Make sure you hit the sub button, of course. We're on our road to 100 subs. Hopefully we get there very soon. But it's been your boy, Blessed Applesauce. Stay blessed. And I'm going to see y'all in the next one, man.
Just to see tomorrow is a blessing. Stay prayed up is the message. Everything about a nigga blessed.